Have you ever just stopped and wondered what really makes the global economy tick? Well, today, we're going to build a super simple but really powerful mental model to understand the entire world of finance. It's all based on the amazing work of Frank Fabazio and Pamela Peterson Drake. And trust me, by the end of this, you'll have a clear framework to make sense of it all.
So let's kick things off with a huge question. What actually powers our modern economy? I mean, how does a brand new startup get its funding? Or how does a massive corporation build a new factory? The answer at its core is finance. You can think of it as the engine, or maybe the circulatory system, that's constantly moving money to where it can be the most productive.
All right, so here's our game plan. First, we're going to look at the big picture framework. Then, we'll dive into each of the three core pillars: capital markets, financial management, and investment management. And to wrap it all up, we'll see how they all fit together. It's going to be great.
Okay, first things first, the big picture. Let's think of this as the actual blueprint for that economic engine we were just talking about. Before we start getting into all the gears and moving parts, we really need to understand the overall design, right?
So what is finance, really? When you boil it all down, it's just a system. A system designed to connect savers and investors, people with extra money, to borrowers, like companies and entrepreneurs who desperately need that money to grow. And this entire system? It rests on those three interconnected pillars we're about to explore.
Let's dive right into our first pillar, capital markets. So if finance is the engine, you can think of capital markets as all the plumbing. It's the essential infrastructure that actually lets the money flow from point A to point B.
And these markets, they do three absolutely crucial things. First, price discovery, which is just figuring out what an asset is actually worth. Second, liquidity, which is just a fancy way of saying you can buy and sell stuff easily. And third, they bring down transaction costs, making the whole system way more efficient.
Now, in these markets, you're mainly trading two types of things. On one hand, you've got debt. Think bonds or loans. That's a pretty simple promise to repay borrowed money plus interest. On the other hand, you've got equity, or stocks. This isn't a loan at all. It's a tiny piece of ownership in the company, giving you a claim on its future profits. It's the difference between getting a loan versus selling a small slice of the pie.
And these markets aren't just one giant blob. They're classified in a bunch of different ways. For instance, you have the primary market. That's where a stock is sold for the very first time, like in an IPO. Then you've got the secondary market, like the New York Stock Exchange, where all those stocks get traded back and forth between investors later on. These kinds of distinctions help bring order to a massive, massive global system.
So, capital markets provide the funds. Now, for our second pillar, financial management, we're going to look at how companies actually use that money. We're moving from the big open marketplace right into the company's cockpit.
So what's the goal here? What are the folks in the cockpit, the financial managers, actually trying to do with all this capital? Well, according to Fabozzi and Drake, there's really one main objective: to maximize the wealth of the company's owners, aka the shareholders. Pretty much every major decision is viewed through that one lens.
And how do they track their success? They use financial ratios. You can think of these like a doctor's checkup for a company. They'll look at liquidity to see if they can pay their bills on time, profitability to see if they're actually making money, and leverage to see just how much debt they're using. But the real magic comes from seeing how these things connect. You see, high leverage might be totally fine if profitability is strong, but if you combine it with low liquidity, well, that could be a huge red flag. This brings us to a really crucial difference: book value versus market value. A company's book value is what the accountants say it's worth based on historical costs. But the market value is what investors out there in the real world think it's worth today. Just look at IBM. Its book value was around $28.5 billion, but investors valued it at over $142 billion. That enormous gap, that represents the market's belief in IBM's future profits, and it's that value that good financial management is trying to create.
Okay, on to our final pillar, investment management. We've seen the markets and we've seen the companies that need the money. So now we're looking at the supply side, the investors themselves who are providing all that capital. This is their toolkit.
So when you step into this world as an investor, you're immediately hit with a fundamental choice. Are you going to try to be an active genius, picking the winning stocks and trying to beat the market? Or are you going to take a more passive approach and just try to match the market's performance? This is, without a doubt, the great debate in investment management.
A passive strategy, something like buying an S&P 500 index fund, basically assumes, hey, I can't beat the market, so I might as well join it. You diversify your money across the board and just aim for the average return. An active strategy is the complete opposite. It's all about doing deep, nitty-gritty analysis to find specific stocks that you believe are going to outperform everyone else.
Now, within that active management world, there are a ton of different philosophies. A value investor, for instance, is basically a bargain hunter. They might look for stocks with a low price-to-earnings ratio, or maybe they'll invest in unpopular companies that everyone else is ignoring. Or they could seek out companies with high, stable dividends. They're all just different ways of trying to find those undervalued gems.
Okay, so we've covered all three pillars. Now for the most important part. Let's connect the dots and see why this framework is so powerful. Because these aren't just three separate topics. They are one dynamic, interconnected system.
Here it is, the cycle of capital in action. It all starts with investment management, as investors decide where to put their money. That capital then flows through the capital markets. From there, companies use it for financial management, to grow their business and create value. And finally, the profits from all that value creation flow back to the investors, to the markets, and the whole cycle starts over again. You see? Each pillar is absolutely essential to the others.
So why does this matter to you? Well, because with this three-pillar structure, the whole financial world suddenly becomes so much clearer. You see a headline about the Fed changing interest rates? Boom, that's capital markets. A company announces a huge new project? Yep, that's financial management. Trying to decide between an index fund and some hot stock tip? That's investment management. You now have a mental model to place everything.
So, we've laid out the entire blueprint for the economic engine. You now have a framework for understanding how money moves, how companies use it, and ultimately, how wealth is created. So the real question is, now that you have the blueprint, what will you build?